The intrinsic value is simply the fair value of the business. In other words, it's what the business is actually worth. The intrinsic value of any stock, bond, or business today is determined by the cash inflows and outflows, discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset. In essence, intrinsic value represents a business's current worth derived from the total of its anticipated future cash flows. To calculate it, two key pieces of information are needed: the anticipated future cash earnings of the business and their current value. These earnings, referred to as an owner's earnings, are determined by subtracting maintenance capital expenditure from the operating cash flow, as indicated in the cash flow statement. The operating cash flow, also known as cash flow from operating activities, is the cash generated by a company's core business operations within a specific time frame. Conversely, maintenance capital expenditure represents the funds expended to sustain and uphold the company's current competitive standing. However, the challenge arises when calculating owner's earnings, as not all companies are obligated to disclose their maintenance capital expenditure, while some outstanding companies choose to provide this data, which proves immensely valuable. The majority opt to not to. Consequently, many investors resort to using total capital expenditure in lieu of maintenance capital expenditure for their calculations. This involves examining all the cash on the cash flow statement. This category encompasses both maintenance capital expenditure and capital spending aimed at business growth. For simplicity, we'll also utilize free cash flow in our calculations. With this understanding, let's now delve into calculating the intrinsic value of a hypothetical business, such as a local corner store specializing in snacks and beverages. To keep things simple, let's say that this corner store had a net income of $100 each year for the past 10 years. And in this example, pretend $100 a year is really good. Now, suppose we're assessing the value of a corner store. Assuming that free cash flow mirrors net income, we can calculate its discounted cash flow, DCF, as follows. Forecasting future cash flows, we project that the store will maintain a $100 free cash flow for the next 10 years. Applying a discount rate, to determine the present value of these future cash flows, we employ a 10% discount rate. Utilizing discount factors, we calculate discount factors for each year using the formula discount factor equals 1 divided by 1 plus discount rate power to the nth number. For example, the discount factor for year 1 is 0.9091, while for year 10, it's 0.3855. Calculating discounted free cash flows. By multiplying the free cash flow for each year by the corresponding discount factor, we obtain the discounted free cash flow for that year. For instance, the discounted free cash flow for year 1 is discounted free cash flow equals $100 times 0.9091 equals $90.91. Summing up the total, we aggregate these discounted free cash flows for all 10 years to arrive at the total discounted free cash flow, which amounts to $614.45. Therefore, based on our calculations, the store's present value, if we were to make the purchase now, is approximately $614.45. The reason why the calculated value isn't exactly the intrinsic value is because the cash flows we anticipate receiving in, say, the 7th, 8th, or 9th year of ownership are not as valuable to us as the cash flows we expect in the near future. The primary reason for this is the time value of money. In this analysis, as noted previously, we are using a 10% annual discount rate to account for our investment goals. When we discount all these future cash flows, including the one-time cash flow from selling the business in 10 years for 10 times its free cash flow, we arrive at the present value of all the future cash flows. This sum represents the intrinsic value of the business to us today. To illustrate this point, consider if I were to offer you $10 now or $10 a year from now. You would likely choose the $10 now. That's because you can take that $10, invest it, and potentially turn it into $11 or more over the course of a year. So you're essentially $1 better off by having the money sooner. This concept underscores the importance of discounting future cash flows to their present value, reflecting their true worth to us today. Investing acknowledges the inherent unpredictability of the future and recognizes that human investors can err in their assessments. To mitigate this risk, we incorporate a margin of safety, a buffer, into our intrinsic value calculations. For instance, if we determine the corner store's intrinsic value to be $615, we might consider making an offer when the store owner indicates a price around $400 or even $380. This approach aligns with the earlier point about the time value of money, where obtaining assets at a lower price today can enhance our potential returns and provide a cushion against unforeseen market fluctuations. The extent of the margin of safety is somewhat a matter of personal judgment. Experienced investors, confident in their ability to predict future cash flows accurately, might settle for a 20% or 30% buffer. However, for new investors or those dealing with less predictable or riskier businesses, a 50% margin of safety could be prudent. It's important to note that finding a 50% margin of safety can be challenging in today's market, but that's the mindset investors adopt. They patiently await opportunities where businesses they've analyzed are presented at prices significantly below intrinsic value. Even if predictions go awry, investing with a 50% margin of safety can still yield a respectable 15% annual return. When the market price continues to drop, say by 30% below the intrinsic value line, that's when we encounter the ideal buying opportunity, the sweet spot, or the gold mine. At this juncture, it's time to make the decision to invest in the business. Before reaching this point, thorough due diligence is essential. We assess the company's competitive advantage, scrutinize the management team for skill and integrity, evaluate its debt levels, and ensure that all the pieces align. Overall, I hope you found this information valuable and that you've gained some insights. If you want to see how to turn $1,000 into $1 million by finding other tangibles in a business, I recommend you check out our video about Monster Beverage.